have with your superannuation and any other sources of income outside of super. So my name's Beck Barmer, and with me today is Madeline Gunn, and we're both education managers here at Australian Super. And together we're going to address some of the commonly asked questions that we receive from members in regards to preparing for retirement. Now, if you have any questions throughout today's presentation, please pop them in the Q&A chat box. We can see there's already some questions starting to come through. And our colleagues, Andrew and Yen, are there in the background and will answer any of your questions throughout the presentation. They'll also be popping into the chat box some links as we move through. So please feel free to copy and paste those links into a separate document or open them into another window so that you can access some of that further information. I would like to acknowledge the traditional custodians of the land on which we work, and we pay our respects to elders past, present and emerging, and recognise their continuing connection to land, waters and culture. Now, in light of Reconciliation Week, which started yesterday on the 27th of May and runs through to the 3rd of June, it's a time for Australians to learn about shared histories and cultures, and it's an opportunity for us to understand how we can each contribute to reconciliation in Australia. So the theme this year is now more than ever, and it's a time to reflect and stand up and defend the rights of First Nations peoples. So I'd encourage you to jump onto the Reconciliation website for more information. So we're coming to you tonight from the land of the Darug people and also the Larrakia people. Now, we're going to be covering off on a lot of information in tonight's presentation. So please remember that this is general information only. So it doesn't take into account your personal needs or circumstances. So if there is some information in the presentation that you feel may be relevant to you, it will be suggested that you could jump onto our website and have a look at the product disclosure statements, have a read of the financial services guide, and we'll also be directing you at the end of this presentation as to where you can go for further help and advice. So what matters in retirement? Well, there's a few key points to consider in the lead up to retirement. And those are things such as where you might live. So would that mean downsizing a house that you're currently living in, or making any modifications or renovations to your existing property? Might it mean moving and working out where you'd like to live in another state or territory? What your health considerations are. So what are the things that you're going to do in retirement to stay physical and stay active? And also think about what sort of social connections that you would continue in retirement. Now, the other factors to consider are, well, where would your retirement income sources be coming from? So would that be superannuation, or will there be other sources of income such as the government age pension or rental property income or investments and things like that? So it's starting to consider all of those factors in the lead up to retirement so that when you get to that stage, you feel like you're prepared and ready for that next journey of your life. Now, I referred to income in retirement. So starting to think about, well, where is that income going to come from to provide you with that level of income stream to allow you to do the things that you'd like to do in retirement? So that might mean that you would have access to the government age pension depending on your income or your assets, and we'll talk further about that towards the end of the presentation as what you need to consider in terms of the assets test and the income test. Have you got some superannuation that you will be self-funding? And things to consider would be, well, what age would you be retiring? Might that be before you're eligible to apply for the government age pension? So would there be a period of time where you would be relying or self-funded using your own superannuation or other sources of income? Do you have some savings in a bank account, or other investments that might provide you with a level of income stream? Do you have a rental property that you would continue to receive income from? So starting to think about what those sources of income are to provide you with that the income so that you can live the lifestyle that you would like to in retirement. So we've all started making plans for at different stages of life, whether you've thought about that or not. As you're moving into different periods of your life, you might have started to plan for those. And it can be hard to know where to start when planning your retirement journey. So what are the steps to consider when planning your retirement journey? Well, by attending this presentation, you've taken that first step in understanding what are the things that you really need to start thinking about in the lead up to retirement. It's working out what does your retirement look like, and that's going to be different for everybody. Everybody has a different lifestyle leading up to retirement and different needs and different circumstances. Is starting to think about, well, is it a hobby that you'd like to start, that you might have some more time in retirement that you haven't had throughout your working life? Would it be looking after grandchildren? Or maybe you'd like to keep working and doing some part-time or casual work. It's thinking about how much money you'll need. And you might have heard, figures going around as in terms of lump sums that you might need in your superannuation for retirement. But rather than thinking about that lump sum, a good place to start is, well, what's that level of income that you might need in retirement to fund the lifestyle? And then you can look at some projection calculators and work out, well, what lump sum does that equate to provide me with that level of income stream? And then also determining, well, are you on track to achieve that? And we'll show you where to go for to access some of those super projection calculators towards the end of the presentation. Now, to unpack some of these steps, I'll hand it over to Madeline to talk through a case study of Sam and Lucy, who are starting their retirement journey. So Madeline, over to you. Madeline, you're just on mute.
Thank you. Sorry, everyone. So let's have a look at Sam and Lucy, who are preparing for their retirement. And like a lot of people, they're thinking in their minds of when they'd like to retire, but they're not sure that that's going to be feasible. They've heard that people need considerably more in their super, higher balances than they have. They're both 58 and they'd like to retire in 5 years' time. And we can see on the screen how much they're earning and the fact that together they have 400,000 in their super. They've done a bit of a budget and they feel that $72,000 per annum in today's dollars would be a comfortable retirement income for them. So I think in their case, where we're helping them understand what this all means for them and how what this can look like in retirement, we can put these numbers into our calculator. And when we do that, we can get a picture here of their situation now at age 58 with their current level of super, as I said, for $400,000. And if they continue working and having their employer contributions paid into their super until their preferred retirement age at 63, we're anticipating their balance will be approximately $530,000 in today's dollars, and they retire and live on funds from their super, their preferred level of a retirement income, until they reach age 67, when they apply to receive some government age pension. And this means they've now got two income streams, income from their super and income from age pension, and they can draw less from their super to help it last longer. So from this age, they continue in their retirement, enjoying life with money from super and age pension. And then our expectations are that their super will run out, we think, at about age 81. So this means that from that age, they will be reliant on the full age pension, which won't meet their income expectations. And we note that they haven't actually reached their average life expectancies at this stage. So we would be suggesting to them the sorts of things they can be thinking about to perhaps improve this outcome. And of course, foremost would be, are they in a position to add some additional funds into super, and how they can do that. And when we talk about making contributions, often the first style of contribution we talk about are, it's a great name, concessional contributions. We're talking about before tax contributions. So here we're talking about contributions made into super before any tax has been paid on those funds. So pre-tax contributions, often a very tax-effective strategy. Employer contributions, salary sacrifice, tax-deductible contributions, and you can make this style of contribution up to a maximum, a total amount for, when we add all these together, of currently $27,500 per annum. And so this can certainly be an effective method to increase super in a nice tax-effective manner. So while we talk about this cap for each financial year, there can be a mechanism for some people to actually look back on prior years to see, hey, if I haven't used up my cap in previous years, and we can look back over a 5-year period, if my balance in my super account at the end of last financial year is less than $500,000, I can look back on these 5 years, and if there's any cap I haven't used, I might be able to use them in this current year. We call this the carry forward rule, and it works in this manner. So this is a very busy slide, but what it's telling us is that in this circumstance, in the 21-22 financial year, when the cap was $27,500, in this instance, the individual has received employer contributions of $10,000 and haven't really given it much thought and have moved on to the next financial year. But in the background, the tax office has noticed that there is some remaining cap that wasn't used, and they're effectively banking that into next year. So that means in this circumstance, the cap for the 22-23 financial year isn't just the $27,500 that we always talk about. We add to that the remaining cap from the previous year. So in actual fact, it's $45,000. Yep, that's the cap. And so in this instance, the employer contribution has been made again. And when we move on to the next financial year, we can see that there was remaining cap of $35,000. So if we add that into the 23-24 financial year, this individual has an available concessional or pre-tax contribution cap, not of $27,500, but of $62,500, because this has been adding over these few years. Remember, we can do it over a 5-year period. So in this instance, in the financial year 23-24, this individual receives their employer contribution of $10,000, and then they make their own tax deductible contribution of $20,000, and we can see there's still some remaining cap to take forward. So they're building their super and claiming a tax deduction for $20,000. So they could do it in this manner, or they could arrange a salary sacrifice if that suited them better. But we can see here that this available concessional cap of $62,500 with a couple of years feeding into that is a pretty powerful way to lower our taxable income. So when we look at this, quite often people think, yeah, that's quite a good idea, but how on earth would I keep track of that? And we, most of us perhaps don't realise that the ATO is doing that for us. And if we go to our MyGov site and we go into that link into the tax office account, and we can see there is now in the menu a superannuation tab. And if we click onto that, we'll see and look for the carry forward cap, and the ATO will lay out very clearly if we have any carry forward cap available from prior years. So it's worth having a look, because we're not always in a position to make use of this, but when we are, it's good to be prepared and know that it's there, because this can be a very powerful way to be building super in a tax effective manner. So this is something to be aware of in the pre-tax contribution space. Of course, the other style of contribution that's available is, again, a fabulous word, non-concessional contribution. We're talking about after-tax contributions. So we can make our own contribution into super, maybe from our bank account. And so this goes in as an after-tax contribution. And the cap for this style of contribution, which is completely separate from the previous cap I spoke about, the cap here is $110,000. So maybe I'm at a stage in my life where I'm building my super and I've maximized that, I've reached my cap in the concessional, the pre-tax contribution space, and I want to add some more. I might make some after-tax contributions, or maybe I've sold some other assets or received an inheritance, or I've been a good saver and I've now built a balance in my bank account. And it's really my long-term savings, so I want to put some of that into super. That's where these after-tax contributions come into their own. And we make a contribution into super. Of course, no tax is withheld on the way into super, because this is an after-tax contribution. So if we put $10,000 into super, that $10,000 is invested as we'd like it to be. Now, in this contribution space, sometimes people have amounts that are larger than that they would like to put into super. And we can bring to bear here what's called, at the risk of confusing people with all these names, a bring forward rule. And this means if I had in my bank account $330,000, or an amount sort of up to that level, that I wanted to put into super, I might not need to wait to put $110,000 in each financial year. I could put up to 3 years worth into my super this financial year, understanding that I wouldn't be able to make further after-tax contributions in this financial year, next financial year, or the one after. So I've used up my 3 years contribution space. Remember, this doesn't affect my pre-tax contributions, my $27,500 cap that's over there. This is this separate space. So I could put 3 years worth in and understand it's taking up that space for contributions for that 3 year period. And a change that's happened in recent years is that in general, I can make this style of contribution up until I turn 75, provided I haven't reached the cap, the total superannuation balance that I'm allowed to have. Once I have $1.9 million in my super, once I've reached that total superannuation balance, I can't make these contributions into super. So as our balance sort of heads into that space, it's probably a good idea to speak with the fund to make sure that if you're making contributions, that you're obeying contribution rules and working within the after-tax contribution rule space. So these are the sorts of contributions we'd be talking about with Sam and Lucy. And they've been advised to make some before-tax contributions, and Sam to make $15,000 each year in the lead up to retirement, and for Lucy to make before-tax contributions, maybe via salary sacrifice, of $10,000 a year. So they're going to do that. They're happy to do that because when they saw the outcome, they could see that it's going to make a really nice difference for them. So if we look at their circumstance now, we start off at age 58 with their current $400,000 balance. Now, as they work towards their retirement, as well as employer contributions, we also have their own pre-tax contributions going into their super. So when they reach their preferred retirement age of 63, we can see now their balance is expected to be larger. We think $644,000. And when they start to draw the income they prefer, they can do that. They're $72,000 in today's dollars, that income from their super, up until they reach their pension age. and that's when they apply to receive some age pension. And from there, they've got their two income streams. We remember money from age pension, and they can draw less from their super, as in the other scenario. And now we have a look and see how long we expect their superannuation to last so that they can have that preferred level of income through their retirement years. And we can see we expect this level of income to be sustainable to past their average life expectancy. So that's quite a difference for them, and that would make them feel more secure and comfortable with their preferred retirement age. And putting this strategy into place, we expect it will give them the sort of retirement and that level of comfort, that sort of level of confidence that they can enjoy those retirement years. So when we're talking about Sam and Lucy, we're talking about a couple that are wanting to work, keep working full-time in that capacity and retire at their preferred age. We know some people can use a different strategy which might involve perhaps a transition to retirement strategies. So Beck, I think you're going to take us through a different strategy into retirement.
Yes, thanks, Madeline. So we'll look at now a transition to retirement strategy. So as Madeline mentioned, people might use this strategy whilst they're still working in preparation for their retirement. So you can use a transition to retirement strategy if you're working full-time or part-time or even casually. And it can give you some benefits to either start saving more into your superannuation or to utilise this strategy to maybe start to reduce your working hours or your working days in the lead up to retirement. So what happens is you would continue to have your superannuation account there to accept any of those contributions. You'd set up a transition to retirement account side by side, and then the income that you draw from that transition to retirement account will help to top up your take-home pay and provide you with that greater flexibility. So we'll have a look at the next slides as to how that might work. So as I mentioned, you could use this strategy to either save more into your super. And how that works is that when you're doing a salary sacrifice arrangement, so you would have your superannuation account and your transition to retirement pension account, you would start to salary sacrifice into your superannuation account. And by doing so, you can start to minimise some of the income tax that you pay on your income by paying into super instead. So by utilising those tax savings, that helps you to boost your superannuation faster or more than what you would have been able to do without that transition to retirement strategy. Somebody might also utilise this strategy to work less. So rather than the plan to save as much as they can, they might choose that in those years in the lead up to their retirement that they would actually like to have greater flexibility to have more time with family or to start transitioning into retirement by working less. And so by utilising that transition to retirement income, that will allow that person to top up their take-home pay because the hours would have been reduced by working less, so that they can still earn that same level of income but have that extra time off in the lead up to retirement. So how does a transition to retirement strategy works? Well, you could see there that somebody would keep their superannuation or their accumulation account. So all of that accumulated funds in superannuation that have been accumulating throughout one's working life, you could then utilise some of that money to move into a transition to retirement account. Now, the superannuation account would remain in place, and that's because that person would still be working. So then the superannuation account is there to continue to receive any of those employer contributions and also any salary sacrifice contributions that are made. So you can see in this slide here that by those additional contributions, and whether that's through salary sacrifice or whether it's tax deductible contributions, what would happen is that money that you're paying into superannuation, so there's extra contributions, are coming out of your pocket. So that you have the same level of take-home pay, you could then top up that income with a transition to retirement income account. So you can see there that that transition to retirement income account is topping up the take-home pay into the bank account. So then rather than just receiving all of your income from employment, then now you're receiving some income from employment and also now from a transition to retirement income account as well. Now, it is important to note that with a transition to retirement account, there is a maximum amount on how much you can withdraw. So with a transition to retirement account, there is also a minimum pension, and that's starts at 4% and depends on the age band that you're in. But there is that minimum and maximum with the transition to retirement account to keep in mind. So the maximum is 10% that you can draw down. When you move into a choice income account or an account-based pension, that 10% cap is lifted. Now, another thing to consider is that with your superannuation account, so any tax that you or income that you generate within your super account, it's taxed at a rate of 15%. Well, that same tax rate applies with a transition to retirement income account. And when you move to an account-based pension, then there's no tax on any of those earnings. So those are the key differences there. Now, what we'll have a look at is Fred's story. And this is a case study so that we can get an understanding of how a transition to retirement strategy might help Fred in the lead up to his retirement. So here we have Fred. He's turned the magic age of age 60, and he'd like to add to his superannuation account. Now, his current account balance is $175,000, and he's earning $80,000 per year, and he'd like to retire in 5 years' time at 65. So he would like to keep that same level of take-home pay. So let's have a look at how we can help Fred. Now, it's been determined that Fred can salary sacrifice $16,000 each year by utilising a transition to retirement strategy without it impacting his take-home pay. So let's have a look into how that would work for Fred. Now, here you can see this slide is showing with no transition to retirement strategy for Fred. So it's his existing position. He's earning a great gross income of $80,000 per year. So you can see there that that's his taxable income. So his employer is paying in at the current rate of 11%. So that's those employer contributions going into his superannuation account of $8,800 in this year. Now, Fred's paying income tax on his $80,000 of his gross income. He's paying income tax of just over $18,000. So that means that in Fred's hand, his take-home pay is $61,933. Now, you'll see there the tax on the super contributions is $1,320. Now, that's because there's a 15% rate of tax. These are the concessional contributions that Madeline was talking about at the start of the presentation. So these are pre-tax. So that means there is a 15% tax on these contributions. So that's what's showing there. It's the 15% of the 8,800 employer contributions that's going into Fred's account. So Fred's super is increasing by $7,480. Now let's have a look at what Fred's position looks like with a transition to retirement strategy. So his gross income stays the same. He's still earning that same level of income. His employer contributions are the same because he's still working those same hours. So 8,800 is going into his super. Now Fred's doing a transition to retirement strategy. So we've predetermined that Fred can salary sacrifice $16,000 into his superannuation for this strategy. Now, what will happen is because Fred's salary sacrificing into his super, it is reducing his take-home pay. But what you'll see here is, not his take-home pay, his taxable income rather. So instead of his taxable income being $80,000 per year, Fred's taxable income is now $64,000. And that's because he's paid in $16,000 pre-tax into his superannuation account. So it's lowered the amount of income tax that he pays. So rather than paying just over $18,000 of income tax, he's now paying about $12,500 of tax on his income. So because Fred's doing some salary sacrifice, he's now set up the transition to retirement pension account to provide him with a level of income stream so that his take-home pay is the same. So he's drawing down $10,480 from his transition to retirement pension account so that his take-home pay is still at that $61,933 mark. So what you'll see is that the tax on the super contributions has increased because now there is that 15% contribution tax on the employer contributions going in and also the salary sacrifice. And what you'll see there is that Fred's superannuation is now increasing more, and it's now $10,600 because of those tax savings, which is $3,120. That's going into Fred's account to accumulate for his retirement and to give him greater flexibility in retirement because he's got more that he's able to save. Now, what you'll see here is Fred's balance at retirement. So he's reached 65 and he didn't do any of the transition to retirement strategy. So we've estimated that Fred's balance, if he was to just continue as he is with no transition to retirement, would be $251,000. Now, if Fred was to start a transition to retirement strategy, he would have $37,000. We've projected this, that he would have $37,000 extra at retirement. So that's giving him a total balance of $288,000 rather than the $251,000. So in summary, Fred's had the same level of take-home pay. So there's been no change to how much Fred is receiving in his hand. What has changed, though, is where that income is coming from. So rather than his income coming solely from employment, he's now also receiving that income from employment, plus he's receiving the income from his transition to retirement income account to give him that same level of take-home pay. Now, for Fred's scenario, it's allowed him to save $37,000 extra in that 5 years that he had to utilise this strategy. And he saved $3,120 in tax in that first year by utilising the salary sacrifice arrangement. So it's benefited Fred in this scenario. Now, one thing to mention as well is that Fred had met that magic age of 60. So when somebody reaches age 60, any drawdowns that they draw from, whether it be from superannuation or from a transition to retirement account or a choice income account or an account-based pension, those drawdowns are all tax-free after age 60.
Beck, we're here at retirement.
Here we are.
Fast forward from the preparation to retirement to the big day, retirement.
Over to you, Madeline.
Here's what it's all about. I've reached retirement. Now what do I think about? I think is the big question. I'm here. I'm concerned, of course, about income. I've had all this preparation that we've talked about, building our super. We've got the estimates that we should be okay. We get there and we're thinking, okay, I've got my super organised. Am I going to be eligible to receive some age pension? That might have been part of the calculations. Let's revisit that and see where we stand when we actually crystallise these numbers. And am I wanting to make some additional contributions in this retirement phase? Understanding that under recent changes to super rules, I can make some additional contributions into super up until I turn 75. So I might have a bit of a strategy here depending on my own circumstances as to how I finalise this retirement income position. So these ideas will be in my mind if I'm retiring and working out, hopefully, in the preparation that I've been doing and building my super, I've got an idea of how this is going to pan out, because I'm really then going to be focusing on probably that what my retirement income is going to actually be looking like. And when I'm thinking of income from super, and income from age pension, the income from super is generally via an account-based pension. An account-based pension in an Australian super, we call this our choice income account. These are very popular income streams. And I think part of the reason for that is because of their flexibility. Our funds remain invested, so we have our funds in our accumulation accounts while we're working, and at retirement we can choose to transfer those across to an account-based pension and draw an income stream. So we've got our funds, we choose how we'd like those funds to be invested, and we choose how much we would like to draw down. Now, there is a minimum amount that must come out each year, and that changes. It gradually increases as we get older. So once we turn 65, and if we're not yet 75, that minimum amount is 5% of the opening account balance for that financial year. Once we turn 75, we're not yet 80, that increases to 6%, and the minimum amount will gradually increase. When we're in our 90s, I think it climbs to about 14%. So the great news about an account-based pension is that the investment income within that account is tax-free. So while we're working, you might remember our accumulation account. So that's the super accounts where we're making our contributions. The investment earnings are concessionally taxed, which is nice. If we had them in our name, they'd be taxed at our marginal rates. Because these investments are inside the super fund, the investment earnings are in a low tax savings environment with a marginal rate of 15%. When those funds move across in our retirement to an account-based pension, that's a zero rate of tax on those investment earnings. So we often earn a little bit more in an account-based pension. So it's got a lot of advantages to have our funds moved across into a tax-free savings environment. We draw a regular income. We know there's a minimum amount that must come out each year, but there's no maximum. Once we're in retirement with an account-based pension, we can take out what we like. If we need some extra funds, we might want a lump sum for a holiday, for a car. Just remember, if you pull out too much, it might not last, but that's for us to decide. We have access to our funds. We've met our preservation age or reached 65, we can draw out those funds and they're ours. So this is a nice flexible arrangement, and it takes a little while to get used to, because when people think about super all during our working lives, flexible is not one of the words we think of, all the rules of things that we can't do. We get to retirement and suddenly we have often a period, a zone in retirement where we can draw out what we like, and until we turn 75, we can actually contribute after-tax contributions into super, within rules, of course, but suddenly we're in a different space, and this takes some getting used to. Now, I've seen a question come through about the account-based pension, which is quite often asked when, for an account-based pension, we're often asked about the fact that we can't add more money to an account-based pension. So people ask, well, what if I'm over 65 and I've retired, and then I start working again, and then I go back to retirement after that? How do I add money into my income stream? Do I have to start another one? How does that work? And so I think it's helpful to give people an understanding that if I did retire and start an account-based pension, it's true, I can't add more money to that account-based pension. If I decided to do some work and I received some super, or I wanted to make a contribution, it's very easy these days to open up a super account, an accumulation account, to receive those funds. And if things settle again and I decide I'd like to have it all in my account-based pension, I can start a new account-based pension. And when I'm doing that, and on the form it asks where the funds are coming from, I can say, well, they're coming from my accumulation account and they're coming from my old pension account. So I'm bringing the funds together into my new choice income account. So there are certainly ways around the different changes that can happen to us in retirement. it's really maybe speaking to an advisor or speaking to the super fund about how we achieve what it is we'd like to with our super as our circumstances change. But just remember, it's a flexible world when we've retired, and there's usually a way to do these things, provided the funds are staying inside the super system, so we're not working with contribution rules to get things in. So I hope that's answered that question that's come through, because people are often wanting to know what happens in that position. So we talked about an account-based pension, having our funds invested, and of course this presents as well as an opportunity to be having our funds work and increase the balance for us to help our funds last longer. It does present often a bit of angst as people are thinking about investment risk and market volatility. And so when we're thinking in terms of how much investment risk I really want to be taking, and for most people, they want to take a minimum amount of risk and they want to have a maximum amount of return. And unfortunately, we know that's not how investment markets work. Risk and return are related. So for most people, there's a bit of a balancing act happening for wanting some returns, some investment returns into my account to help with longevity of funds, because we think if I removed all the risk and perhaps put it in cash, and if we mapped out expectations of longevity of our funds, we would usually establish that the funds would run out prematurely. We would need to have more funds in the mix generally. So when we're looking at in levels of investment risk, if we take a high level of risk, looking for a high average return, that may not be practical either. So for most people, there is a zone in the middle with a reasonable amount of risk, which is going to be different for different people, and an understanding of expectations of how long my money will likely last, and how that's affected by those levels of risk. So quite often this is a conversation with an advisor around levels of risk and return and longevity of funds. So we've been talking about superannuation as part of retirement income stream, but in Australia, most people are retiring with a mix of their own savings, often within super, and some government age pension. And quite often, even people who start out their retirement years not qualifying to receive any age pension, most people will end up interacting with government age pension at some stage in their retirement. And the key here is that if at some stage in retirement we become eligible to receive age pension, nobody's going to tell us. So it's going to be very important that we understand how this works, so we've got an idea of expectations, so that if we are in that zone, we approach Centrelink and go through that process to make sure that we don't miss out on an entitlement we might be eligible for. So we're really looking to maximise our retirement income for most people with at some stage that mix of retirement income streams to end up effectively with more money each fortnight. So if we start now to look at, well, what do we know about a government age pension? At the moment, we know their maximum fortnightly pension payment, we can see on the screen for a couple combined is $1,683, and for a single it's $1,116. Now most people aren't necessarily receiving a maximum fortnightly payment, receive some part payment, as I mentioned, which coupled with their own super savings gives us an overall larger amount each fortnight to meet our retirement living expenses. So when we're thinking of age pension, we'd then be thinking of, well, when can I apply for some age pension? And we can do that once we've reached what's called age pension qualifying age. And this is an age that has been changing over the years, and we can see now for people born after 1 January 1957, that retirement age for both men and women is age 67. So that means we reach age 67, as we saw in our case study with Sam and Lucy, we can apply to receive some government age pension, and we know the next steps from that will be completing the assets and income test. But first of all, I would like to just compare this age with when we can access our super. because we've talked about accessing super a bit throughout this evening's presentation, and we can see here the ages are completely different. So different legislation, different age, very different, aren't they? So we're currently looking at people who were born from the 1st of July 1964. They're what's termed preservation age. That's the age that if you retire, you can access your super. Now, for people, once they've reached the age of 60, which is where preservation age has moved to, in actual fact, if you retire or if you change employers, if you change your employment, you might move from one job to another, that will release your super as well. If you were received a redundancy, or stopped working altogether, or stopped working and then went back later on, you can access your super at that stage. So age 60 as a preservation age opens the retirement super world to you. I'd also mention that if you're working, you keep working, once you turn 65, you have access to your super whether you're working or not. Your super becomes yours to convert to a retirement income stream if you want. You don't need to be retired. You've reached that age within super legislation. Age 65 gives you access to your super. And as Beck said, once you turn 60, and if you're eligible to receive some funds out of your super, those funds will come to you tax-free, because that's where this interacts with the tax system, and money coming from super once we've turned 60 is tax-free to ourselves. So there is sort of a lot going on in this space, but really we're now focusing on accessing our super. So we've perhaps reached our preservation age and decided to retire, or maybe we've turned 65 and retired, and we're moving towards age pension age. We're deciding to apply for age pension. I've reached 67. Now I am applying for age pension. What are those next steps that we do, Beck? Thank you.
Thanks, Madeline. So we'll look now at the assets test, and then we'll have a look at the income test. So as Madeline just went through in the slides of when you qualify, so there's qualifying ages that you could then apply for the government age pension. Centrelink would then look at your assets and your income and determine whether you'd be assessed under the assets or the income test. So they'd pay you the lower of the two. So we'll look at the assets test first, and what would be assessable under the assets test? Well, it's any property or shares or any bonds that you hold, any investments, managed investments, they would all be accessible. Your superannuation accounts if you're over that qualifying age. So that is the key to remember there, that if you're under age pension age, then that superannuation account won't be accessible. So if you think about a member of a couple where one person might be over that qualifying age for age pension, and the other member of that couple who isn't yet at that age pension age, well, that person who's under age pension age super wouldn't be accessible. Any pension accounts, so that's including any of those transition to retirement accounts that we spoke to a little earlier. Any household contents or any boats or caravans. And there are also gifting rules. So Centrelink will assess any gifts that someone has made. So you can gift $10,000 in a year or $30,000 over 5 years. Anything over and above that would then be accessible for under the assets test. So now let's look at what would be exempt. So the family home, so that principal place of residence, wouldn't be counted under the assets test. Any super accounts, as I just mentioned, of somebody who's under age pension account, well, that wouldn't be accessible. Any funeral bonds or cemetery plots. So funeral bonds are currently aren't counted up to an amount of $15,000. So those amounts are assessed on the 1st of July, coming up to that shortly, each year. You can find out more information on what's accessible and not on the Services Australia website as well. So we'll have a look at the assets test. So what you can see here is for a single person down the left-hand side, and then you've got underneath that couple. So this is combined. So if we look first at a homeowner, so if it was a single person who was a homeowner, they would be eligible for the full government age pension if their assets fell below 301,750. Now, there might be a part pension entitlement if we're looking at that single person who's a homeowner. They might be eligible for a part government age pension if they had assets between that 301,750 mark up to 674,000. Anything over and above that 674,000 in terms of their total assets, then they wouldn't be entitled to a government age pension. And you can see also there, if we looked at a couple and we looked at, for the next example, a couple, so this is combined assets. If they're a non-homeowner, well, they could have 693,500 of combined assets to be receiving a full government, anything under that, a full government age pension. And then they would be entitled to a part government age pension between that 693,500 mark and about 1.254 mil. Now the income test here, so if we're looking at the income test and what the maximum pension is if your income, let's look at for a single person. So they'd be entitled to a full maximum pension if their income was below $204 per fortnight. Now, again, that single person would be entitled to that part government age pension if their income was between $204 a fortnight and $2,436. And you can see there what that income test, if someone was assessed under the income test, what that maximum pension would be if they're a couple and where they might receive that part government age pension. Now, a thing to note here is deeming rates. So with the income test, if somebody was, for example, assessed under the income test and they had investments where they were receiving, say, let's just say, for example, 6% they were returning as an investment return. Well, Centrelink actually applies what's called deeming rates. So it's a more concessionally deemed or treated rate of income. And you'll find more information about that on the Services Australia website. And there is some threshold limits there, but it's about 2.25% is what that deeming rate is. So it's more concessionally advantaged, I guess, there with the income test. Now, what we'll have a look now is concession cards. And Madeline, I'll hand it over to you to talk us through what sorts of concession cards are available.
Thanks, Beck. Yes, I think people have often heard of or are very aware that when they receive age pension, they can become eligible at the same time to receive the pensioner concession card, which has some nice benefits associated with it, and people are usually quite pleased to receive this and to receive even a small age pension to have access to this concession card. We just want to make sure people are also aware that maybe if you've reached age pension, you've retired, reached age pension age, but you haven't qualified to receive some age pension, quite often we find that people are eligible to receive the Commonwealth Seniors Health Card. And that's because this card is managed differently, so it's not asset tested. And the income test is different. It's largely focused on adjusted taxable income, and it's got added to it deemed income from an account-based pension. But it's a very generous threshold, and it's certainly worth inquiring about if you find yourself perhaps retiring, not eligible for age pension. Have a look at the Commonwealth Seniors Health Card. And if you're retiring and you haven't reached your age pension age, in the same process, same thought process, have a look at the low income healthcare card, because again, focusing on adjusted taxable income largely, and we all know that income from super is outside the tax system and so is often not counted in this regard. If we then have a look at a couple of other Centrelink features, just tapping into those so people are aware of the work bonus scheme, which is a bit of an incentive, but also I think just something that's often useful when people are retired and settled in receiving some age pension. And then there might be an opportunity to do some work, and people will often put off because it would upset their age pension arrangements. We are now have the work bonus scheme in place where the first $300 of gross fortnightly income won't actually count towards our age pension income test. So this amount is effectively banked in our work bonus account, if you like, with Centrelink, so that along the way it builds a 300 a fortnight to a balance of up to $7,800 a year can be earned in this regard. And in recent times, there's been a $4,000 bonus added to that. So if people start this work bonus arrangement, they will find that there's $4,000 credited to that account to start with. So again, when people are planning their retirement, good to know this exists and to have a look at it if it's something that's going to be applicable for your retirement. Another scheme that is perhaps not widely known through Centrelink is their Home Equity Access Scheme. So this is essentially a reverse equity mortgage with Centrelink. So reverse mortgages has not been a very well developed area within Australian finances, and Centrelink have stepped into this space because it probably makes sense now that we have probably homes in capital cities of Australia worth substantial amounts. And we may have people who are retired who perhaps have insufficient regular income to meet the sort of living expenses or the sort of retirement they'd like, but they're living in an asset worth considerable amount of money and they would like to spend their retirement there. So an option under these circumstances is to consider a home equity mortgage with Centrelink, receiving income from Centrelink, understanding, of course, that on sale of the home or in the event of our death, that loan would be repaid from the proceeds of the sale of the property. So it is something that people are often not aware exists, and it's just one more item we can have in our toolkit when we're mapping out our own pathway, our own journey through retirement. Now, right at the end here, which is not Centrelink at all, but we've positioned the downsizer contribution quite separately from the other contributions to super because it is very different. What makes it different? Well, it's a contribution that doesn't obey other contribution rules. So we need to be aged 55 or older to be able to use this contribution strategy. There is no upper age here. So, hey, we could be in our 90s and decide this is for us. But we can only do this once in our lifetimes. So this is a one-off contribution opportunity where in the event we sell our home where we're living and we may be downsizing to another property, the key is the sale of our family home or our home where we're living, we are then able to contribute up to $300,000 as an individual into our super. So this is quite a nice opportunity because in the past, this sort of thing has often happened when people were above age limits where they could add money to super, and they would be looking for an easy methodology to invest perhaps these surplus funds. And so this style of contribution has sort of filled that gap and enabled people to effectively boost their super with a transaction such as this. And of course, for a couple, that is double that amount, so it can be up to $600,000. But importantly, and we are often asked if a couple can put these funds together in one super account, and the answer is no. It would be $300,000 into their individual accounts each, adding to a total of $600,000. Now, there are some very strict rules around the timing of this transaction. So if this was something you were looking to do, you would want to make sure you've looked through those rules and perhaps sought advice so that you follow the rules and make sure your contribution is valid. And
Excellent.
now, over to you, Beck. We'll talk about nominating who gets your super.
Thanks, Madeline. And as Madeline mentioned, we're going to talk now about nominating who receives your super. So superannuation sits separate to your estate. So just because you have a will in place doesn't mean that your superannuation will be distributed in accordance to your will. So it's really important to consider a beneficiary nomination underneath your superannuation account or your account-based pension. Now, there are different types of beneficiary nominations that you can have, and they're binding nominations, non-binding and reversionary. So now with a non-binding nomination, you can think of it more as a preference as to who you would like to receive your money. When you have a binding nomination, the super fund is bound to pay, as long as it's a valid binding nomination, to pay your superannuation to those beneficiaries that you've nominated. So it can make sure that your loved ones receive your superannuation on your death in a timely manner, and you have that surety to know that those people that you've nominated are going to receive your money. Now, to have a valid binding nomination in place, you need to have, because your superannuation doesn't form part of your estate, it's a legal document that you have to complete. So a binding beneficiary form, which means that on that document, you have to have 2 witnesses sign, and it has to be completed down to a T. So all of the information needs to be completed in full. It has to total 100%. And we'll have a look on the next slide as to who you could nominate for your nomination to be valid. So with a reversionary nomination, that is for a choice income account or an account-based pension only. And what would happen under a reversionary nomination is that with the choice income account or an account-based pension, you're receiving a level of income stream. Now, with the reversionary nomination, that means that you would like to nominate somebody to receive that income stream. And you could complete somebody for that, put down who you'd nominate, and then that person on your death would need to complete an application form just to say, this is my name and details, to them for the fund to be able to revert those pension payments to that beneficiary. So you'll find more information about those different types of beneficiary nominations on our website at australiansuper.com/beneficiaries. But let's have a look now at who you can nominate. So for it to be a valid nomination, it needs to be your current spouse or partner, a child of any age, so they can be over 18, somebody who's in an interdependent relationship with you. So that might be somebody who's you're caring for, they might live with you and you're caring for them and looking after them financially, for example. An example of that might be that it's a grandparent and their grandchild is living with that grandparent and they're caring for them and providing for them financially. Any other financial dependents, or your legal personal representative. Now, if you nominated your legal personal representative, that would be nominating your estate or the executor of your estate to distribute your super. So because your super sits separate to your will, you could nominate your legal personal representative, and then that would mean that the executor then would of your estate would distribute the money. Now, there are different rules for who you can nominate under superannuation legislation and who would be a dependent for tax purposes. And there are some extra webinars or another webinar, estate planning, if you'd like to know more about what those differences are in regards to superannuation dependents and taxation dependents. So we've covered off on quite a fair bit of information tonight in helping you to plan for your retirement journey. And we hope that you've taken at least one key piece of information that you either weren't aware of or clarified some information for you that will help you with your own personal retirement journey. Now, where can you go for extra help and advice? Well, we have plenty of calculators available on our website, which you'll find at australiansuper.com/calculators. We referred to the super projection calculator earlier, so you can plug in what your super balance is now and when you would like to retire and project out what your superannuation balance might look like at that point, and then also play around with making extra contributions and what that difference would be to you. You can also register for other webinars. So like the one that you've attended tonight, there are live webinars or there are pre-recorded on a range of different topics that might be of interest to you. Now, as an Australian Super member, you're eligible to receive free simple super advice on things such as, well, I'd like some help on who I might like to nominate as a beneficiary and just a little bit more information on that. It might be that you're unsure about investment options and need some help to understand what your risk tolerance is to be able to make a decision as to where you'd like to invest your money within super or pension. Or if you'd like some help on insurance, well, you could call our 1300 number and speak to a financial planner who could give you that simple super advice. Now, if it is anything more comprehensive than that, and you do wish to seek financial advice, you can request to speak to a financial planner, and you can either call the 1300 number or jump onto our website and find an advisor. And a financial planner would go through your existing position and really get a good understanding of your current position, both personally and financially, and what your goals are. And then there would be a cost involved to prepare a statement of advice document for you. Now, that would all be agreed upon with you and the planner before you went ahead, but they would prepare a financial plan or a statement of advice document that would detail your current position, where you'd like to get to, and the advice that would help you to meet your goals. Now, you can find more information on the discussion points that we've gone through today on our website at australiansuper.com/journey. So we thank you for joining us this evening for this presentation. And there have been a number of questions that have been asked throughout the presentation. So Andrew and Yen have been doing a wonderful job of answering those. We will leave the webinar open to allow the time to ask a few more questions. So the education team are answering those as we move through.
And Beck, I just wanted to cover off a couple of those questions because I can see someone's come back wanting to know from my explanation earlier, wanting to understand better how you actually add to a choice income account.
Mm-hmm.
So I thought I would just cover that off slightly differently so that people can understand in a circumstance where someone has started a choice income account, then perhaps receive some funds that they would like to contribute to super and add to their choice income account. And the fact we all know, we've all heard that we cannot add money to a pension account. So how do I do this? And we set up a new super account and we contribute within contribution rules to that super account. And then we apply for a new pension account, a new account-based pension. Now, when we do that, the form is going to ask us where the funds are coming from to start this account. And on that form, we would be listing two places where the funds are coming from. They're coming from our new super account, so that money is going to be transferred to our new account-based pension account. And they're also coming from our old account-based pension account. So we've got two sources of income within the super system, two sources of funds from the super system being transferred or rolled over into our new account-based pension. So we're effectively closing the super and the old account-based pension, and we now have one new account-based pension with all those funds that were within the super system within the one account. So it is fiddly. I'm not suggesting it's not. It's really because within current legislative framework, the rules around accumulation accounts and income accounts dictate that an accumulation account can't pay out income and an account-based pension can't receive contributions. So this is really the method of going around that. And for a lot of people, they would speak to a financial advisor around making sure that this process happened in the manner that it should, because I can appreciate it does sound very fiddly. There are a few other questions that have come through. Just having a look here for things that might be. Someone is asking for us to explain the significance of the $500,000 threshold for super contributions, please. So I think what's being referred to here is the carry forward rule, which allows us, if our balance at the end of the previous financial year is less than $500,000, we are able to look back over the last 5 years, so it's a rolling 5-year period, and if there's pre-tax contribution cap remaining that we haven't used, we may be able to use them in this financial year. And really, I think the place to look to see whether we have any carry forward cap, would be looking at our MyGov site, looking at the ATO account that we link to there, because that's where the records will be, and the ATO will take into account our account balance. So we'd have a look there and see if for each of those financial years the carry forward cap amount has been itemised for us by the ATO, because that's where we go to have a look and see, well, yes, I've got some cap here. It says I have this amount. I can use all that in this financial year. And importantly, I don't have to tell the ATO I'm doing it. I don't have to fill out any forms, because I'm utilising what's been calculated by the ATO in my tax account, in my super account within my tax account. And they will then, when the returns come in at the end of the financial year, that will all be recalculated, and we'll be able to see those transactions in that account as well. So it's really a bit of a self-serve, going in, seeing what's been itemised there for us by the ATO, and being able to utilise that. And when the next sort of financial year rolls on and the reconciliations are done, the tax office updates that data for us, and we'd be able to see that.
Thanks, Madeline. There's also another question here on the carry forward of concessional contributions, and the question is around if you use the carry forward, can you use post-tax money and then claim back the tax paid? I think what this question is asking is, can you make a contribution into super as part of that carry forward and then claim a tax deduction on it? Well, that would mean completing it. You can pay into superannuation, and it would be as long as you're within those carry forward limits on your MyGov account. You could then pay a contribution into superannuation and then complete a notice of intent to claim a tax deduction form, and then that would then convert that after-tax payment that you've made into superannuation into a pre-tax contribution. So a notice of intent to claim a tax deduction form is what somebody would complete to change that contribution type.
I think it would be important for people to understand that if they've used the carry forward rule for the 3-year rule and made a $330,000 contribution, if they then claimed a tax deduction for part of that, remember the limit is $27,500 for pre-tax contributions over here, we're then moving $27,500 of that across here to be a different type of contribution. So I think if you were getting into that space and you aren't 100% comfortable with that, I think it's worth seeking some financial advice. Even if you start with our over the phone simple super advice line, to just track through the strategy you actually have in mind. Because in a forum like this, this is not providing personal financial advice, and we don't know anything about circumstances. So I always think when someone is talking about contributions and we're getting into large numbers and near limits, it's a really good idea to talk one-on-one
with a financial advisor, probably over the phone as part of that Simple Super advice line. Remembering that if you receive financial advice, personal financial advice via that line, you will receive that in writing in a statement of advice. So I recommend strongly that in that circumstance, people would seek to have their situation clarified and talked through for their own personal circumstances. Someone else has asked, Beck, about with an account-based pension income, do I need to declare it at the yearly tax return together with my other income, such as rental income? So when someone is talking about their tax return, I'm thinking on the form, I think there are places to add account-based pension income, but it is not taxable income. So it's not going to add to your other taxable income. But there will be people who are retired receiving their account-based income, pension income, and not filing tax returns because they don't have taxable income. So it's not a requirement for that sense, but I think if you're filling out a tax return from memory, I think there is a place on the form where it does ask if you've received income from a superannuation fund. So again, if you were looking at that from your own position, this is not personal financial advice, you would probably want to speak with your accountant about that, who would know your circumstances and be able to walk you through where you need to put the different types of your income on that form. There is another question with someone asking, with my current super amount, I don't qualify for age pension. Can I withdraw my super faster than usual so that I can get an age pension, a Centrelink age pension earlier than normal? So it's not just, I would be saying it's not just withdrawing super, you probably need to spend it. So for some people, they may decide that they're going to renovate their home and that may use up some of their funds. Other people, because we know that our house is not counted as part of the assets test. So again, seeking advice around your situation, particularly if you're on the threshold where you're near the boundary, there may be some things that you can do which are something that would be part of perhaps what you were going to do anyway. Maybe have a holiday, maybe there are some things where if it brings your accounts down, then you may find yourself qualifying. So again, I would probably speak with an advisor around how that fits together under your circumstances. There's another question here, Beck, about, again, opening accounts, opening a pension account. Given a couple of years, can I combine the residual super to reopen a new pension? Is that part of this? It does prey on people's minds, I know, about having a super account and a pension account, and then how I bring the funds together. And that would be, again, this process of starting a new pension account and bringing the funds together in the new pension account, effectively rolling that pension that exists now back behind the scenes, back into super and starting a new pension. Mm-hmm. So I think there is a mechanism to do that. And if you're not comfortable with that, then I would probably call the fund, speak to probably a phone financial advisor to start with, to see at what level of support you might need, and work your way through that. It's worth making sure these things are done correctly, rather than finding the hard way that you haven't quite understood, or the mechanism hasn't quite worked how you thought it would, and it can result in not a good outcome. So if you're not comfortable, how about calling the phone advice service we have and talking through your position with them, and they can talk to you about a personal situation and the pathway forward perhaps for you. There is a question around, do I have to leave something in my original accumulation account when I open a choice income account? So this is quite important. If someone wants to keep their original accumulation account open, when they open the choice income account, they need to leave a minimum balance of $6,000. But quite often what happens is that because it is so straightforward to open a new accumulation account, it's not like it used to be. It's go online, establish an account, and you have a number. Quite often people just roll the whole thing over and have their new choice income account, and then when they need an accumulation account, instead of just keeping it there in case I need it, which is what we used to do in the past, it's very straightforward to open another account. Okay.
I think we're getting to the end of the.
Working our way through the questions. There's been a lot of great questions tonight. So I hope that people have been able to sort through this information, because we have presented a lot of information tonight, and it can become quite confusing to sort of, focus on each of the details as we come across them. But as Beck pointed out, on the Australian Super website, australiansuper.com/journey, you'll find a lot of this information there aggregated together. So that might be a useful landing page where if someone wants to go back, and there have been quite a few links added to the chat. If you wanted to copy and paste them perhaps in a Word document, you can have a look at those, review those later on.
So Andrew's just answering one last question here, and then we might finish the webinar for this evening. So we'll allow Andrew another minute or so to type in his answer. Excellent. That looks like all of the questions have been answered. So once again, thank you for joining us this evening, and have a wonderful night.
Thank you, everyone.
Thank you.
Good night.
Bye-bye.